Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Ngwiri and I practice within the financial services industry in Kenya. Today, ladies and gentlemen, we are discussing about portfolio management. The focus of today's class, ladies and gentlemen, is contemporary issues and emerging trends. We are going to narrow down our discussion towards investing in international markets. Now, what we're going to discuss under this wonderful topic of contemporary issues is just the general issues or the issues which are being discussed along in foreign markets and also in our local markets right here in Kenya. We are going to discuss about the considerations before investing in foreign markets, and then we're going to move ahead and discuss about the methods of investing in foreign equity securities, and thereafter we're going to look at the factors to consider before investing in foreign markets. So let's dive right in, ladies and gentlemen. We start by mentioning the following, ladies and gentlemen, that the considerations to be the considerations to be factored when investing in foreign markets, international markets include, so put it like that. Number one, we talk about political factors, or what we call geopolitics, political factors. What we're saying is how peaceful is the country in as far as politics is concerned. So this is a consideration that you need to factor in. So I just put a bullet over there and say geopolitics and its influence on foreign direct investment. Geopolitics and its influence in or on foreign direct investment. Number two, ladies and gentlemen, so just going to bring about some distinction there. Political factors, going to be very brief, not too detailed. Number two is economic factors, right there. So probably, maybe at that point, you may not really get to understand what we are talking about when discussing about investing in international markets. Let me just bring you up to speed. Please forgive me for that. So we are saying that this is, say, for example, Kenya. We want to invest in Uganda, right there. Possibly, maybe in Tanzania. That. I'll use TZ to denote Tanzania, UG to denote Uganda, and K to denote Kenya. So what are the considerations before a Kenyan wants to invest in Uganda or a Kenyan wants to invest in Tanzania? The first factor, ladies and gentlemen, is political factors. How is the politics or the political temperatures right over here? Could be, say, for example, in one of the countries over here, you could be able to have a regime that is kind of dictatorial. It may not really be able to allow for foreign direct investment to come into their countries like that easily. The second point right over here, we're talking about economic factors. So the economic factors of these countries, because you're saying that the Kenyans over here want to invest in Uganda, so the factors, the talking points over here should be the GDP, inflation, interest rates, and possibly exchange rates, amongst other factors there. So when talking about economic factors, we say the influence of GDP interest rates. This is gross domestic product. The interest rates, exchange rates, We're talking about inflation. All these have an influence towards Kenyans investing in Uganda and investing in Tanzania. If, for example, the GDP is not, is probably maybe the growth rates in Uganda and Tanzania are not up to the speed that the Kenyans actually want, then they would be able to prevent them from investing in those countries. Because probably maybe you're holding a portfolio right over here. This is just an example, guys. And probably holding a portfolio over here that also wants to grow. You want to grow the value of the portfolio. And the only way to do it is to invest in those economies that also produce significant growth in GDP, inflation, rather GDP only, and maybe inflation rate. You'd want to have modest amount of inflation because you're saying the purchase of goods and services or purchasing power in Uganda and Tanzania, if you put it on a Kenyan scale, it might also be quite expensive for the Kenyans to actually put it to invest in Uganda there. The interest rates, the prevailing interest rates, a 10-year bond yield, is it, or maybe the lending rates within Uganda and Tanzania may not really be favorable over there. The exchange rates, Kenya shillings to Uganda shillings, probably the Ugandan shilling is actually strengthening more than is actually strengthening more than the Kenya shilling. Then that actually would present an opportunity for the Kenyans to actually invest in Uganda shillings, because we're seeing the Uganda shillings is actually strengthening against the Kenya shilling. So that's what we're saying. Currency risk or currency exchange rates needs to be factored in or needs to be considered when investing in international markets. I'm just using this as just an example over here. These same factors also affect when you want to invest even in European countries and also in the US there. So domestic factors, we're saying that the influence of GDP, interest rates, and exchange rates, inflation on the investment manager's portfolio, on the investment managers. We go up over here, portfolio. So those have an impact on the investment decisions as to whether you're going to invest in Uganda or Tanzania or wherever, Europe or even the US. Next point, we're talking about socio-cultural factors. Number 3, social-cultural factors. Socio-cultural factors, and we're saying these socio-cultural factors considered needs to be based on cultures and beliefs. So we're saying that the cultures, beliefs, and maybe traditions have of a given country have an impact on investments, on foreign direct investment. Foreign direct investments. This is how so. We can come back over here to a diagram over here, to a drawing. We're saying that if we are saying we have a predominant, if just for example, if you're saying that in Kenya that we are predominantly maybe say for example Muslim or are believed to have the Muslim faithful or have a following towards the Muslim proposition, then we would only seek to invest in those countries that have got Sharia compliant laws or products. So those are what you're saying, the cultures and beliefs. And we're also talking about maybe say if Kenyans, for example, are also predominantly Christian, then it would mean that they would want to invest in countries probably that have got maybe the norms and the cultures that are almost similar to what the Kenyans actually believe in. Like that. So that also has an influence in foreign direct investment. Foreign direct investment from that country, from Kenya, cannot be able to come into Uganda as expected, because probably maybe there's a barrier in terms of cultures and beliefs and norms, as well as traditions. So moving on, we can talk about, I'm just being very brief, number 4, and for consistency purposes, I was supposed to underline this using red. Forgive me for that. Here. Socio-cultural factors. And number 4, we're talking about technological factors. Technological factors. And we're saying technology, the impact of technology, of course, following the adverse effects of COVID-19 pandemic, led to innovations of how individuals can actually make, conduct meetings, trainings, and even modes of payment. It can also be done through using the over the internet there. So of course, individuals came up with payment platforms that can allow seamless seamless transfer of funds without any risk over there. And that means what? Precise point is this: commercial banks actually used to have probably maybe a given number of tellers, and even now what you're saying, automated teller machines. Now you're saying that individuals to some extent are not going to automated teller machines as the way they used to. They are now, because of the innovation that has been done by the CB, commercial bank, towards payment platforms online, as well as mobile banking, has actually transformed the commercial banking ways of doing business over here. Now, in terms of the tellers, you don't find as many tellers as the way they used to be, because you can be able to conduct your transactions online or via your mobile phone. So we're saying advancements in technology, has allowed individual and institutional investors to invest in foreign equity securities or foreign securities, removing bottlenecks, that were previously in place. Because we're saying that nowadays you can even trade using just a mobile banking, just using your phone. You can even trade on cryptocurrencies, you can even cryptos, and you can also trade on currencies, you can do also on commodities, just by the confines of the convenience of your phone. So you don't really have to physically go to an exchange or even do it on online or using a computer machine and so on and so forth. That's the way it is. That's what we're talking about, ladies and gentlemen. So technological factors also have brought about ease and the way individuals actually transact. So in a country that is technologically savvy, then there's going to be a challenge in terms of how you can be able to execute investment decisions there. So if countries are not moving with a fast pace at which technology is actually growing, so you'd expect then there is going to be a hindrance in terms of receiving foreign direct investment there. 5 there. So we talk about social, cultural, technological, and then there's ecological factors. Our commercial banks are financial services firms firms financing initiatives are financial services firms financing initiatives that drive or that cater for climate change, cater for climate change. That is a question mark over there. Commercial banks right over here, what are they financing? Who are they providing loans to? Are they providing loans to individuals and institutions and for a noble cause that are geared towards climate change or that are geared towards conserving the environment? My apologies. That's the question that should be asked. So if commercial banks over here, CBs, are financing, say, activities that pollute the air, maybe even geared towards, maybe to some extent, civil rights, or maybe civil rights ecological is geared towards the environment, So it's civil rights is probably maybe legal environment. So pollute the air and maybe conserve or maybe are geared towards maybe bodily harm, causing bodily harm like that. Say, for example, I'm just using this as an example, BAT, British American Tobacco Cigarettes, producing company. So what are commercial banks' activities geared towards? Are they geared towards polluting the environment or providing finance to firms that pollute the environment? Or are they providing loans to institutions that are going to produce products that cause bodily harm, including cigarettes, alcohol, and so on and so forth like that? That's what we should be able to consider under the ecological factors. And that really affects. So if BAT is trying to seek financing or investors want to invest in BAT, and then there's going to be a deterrence. There's going to be some foreign direct investment may not really come because they're saying that the element of ecological factors are going to prevent them from receiving finance from commercial banks or from maybe say investors in foreign countries their own. So that is ecological factors. And we move on to this other side. We discuss other factors. Here, after ecological environment, we move ahead and discuss about legal environment, legal factors. And we're saying under legal factors, we talk about the impact of regulatory change on securities holding. So if initially the allocation or the preferred allocation from the regulators was saying it was going to be 0.25, 0.25, 0.25, 0.25, like that, all a quarter like that, we are saying that it changes and says that this is equities, fixed income, derivatives and alternatives. It changes and says that the preferred portfolio should have something to do with something over here 0.35 and here it's 0.15, for example, like that. This is 2.5. So it means that the portfolio holding or foreign direct investors would have an appetite. If initially they had an appetite for this, they'll not be able to provide financing to this part over here as much as the way they did because of that regulatory change. We're also seeing activities that are geared towards civil rights, like that, and so on and so forth, might also be contributory towards foreign direct investment. Individual investors or institutional investors may not be willing to invest in countries that do not follow or are not observant of civil rights or civil activism, civil activists, and so on and so forth like that. So that is part of the legal factors there. So it would deter foreign direct investments. Countries would not be able to invest in those countries which do not follow or do not have civil rights. So other factors include, other factors over here include, and we're talking about something to do with country risk. Country risk. Country risk. So talk about country risk. This is the risk that is posed by a country, especially in trying to determine maybe in terms of its credit rating, its ability to borrow from international markets, say maybe from the World Bank, the IMF, and so forth. So this country risk is also a factor that deters foreign direct investment or investing in international markets. Then we're also talking about maybe transaction costs. Transaction costs in the foreign country where you would wish to place an investment. If the transaction costs are actually high, then that would deter participation in foreign direct or in foreign or international markets. The next point over here is currency volatility. Currency volatility. Of course, ladies and gentlemen, I had discussed right over here about the exchange rates. So probably maybe I may not it would not be necessary for me to explain this point again because I already talked about it in the currency exchange rate. And I said the currency, how erratic is the currency exchange rate? Maybe say, for example, the KES versus the Uganda shilling, like that. Is it very volatile? At one time, is the Kenya shilling losing ground against the the Uganda shilling, or is the Uganda shilling losing ground against the Kenya shilling? How erratic that moves would affect foreign direct investment or participation in international markets. We're also seeing the final point is liquidity. When in participating in international markets, liquidity is a key concern, and maybe you're investing in markets that do not provide liquidity or are not as liquid as maybe say foreign markets. Maybe emerging markets may not provide that element of liquidity as much as foreign markets would do. So that would deter investors in participating in international markets, there. So having discussed the considerations when investing in international markets, we can then move on and discuss about the methods that are used in investing in foreign equity securities. So methods of investing in foreign equity securities. We can do that right on this other side here. Methods of investing in foreign equity securities. Methods of investing in foreign equity securities. Methods of investing in foreign equity securities. So how do we invest in foreign equity securities? The first method is we can mention American depository receipts. Number one, American depository receipts. What is also called as ADRs. Under ADRs, we say that are a convenient way, are a convenient way to buy foreign stocks or foreign securities. To buy foreign securities. Convenient way to buy foreign securities. Foreign companies use American depository receipts or ADRs. Use ADRs to establish a presence. In the US markets. the US markets, and sometimes have some capital, sometimes require capital. These are what we can say a convenient way to buy foreign securities. We're saying foreign companies use ADRs to establish presence in the US markets and sometimes require capital and sometimes require capital. I'll move on this other side right here. So we say that each ADR that a foreign company issues represents underlying share, an underlying share, I'm not written it properly, underlying share or number of underlying shares. They are listed, traded. They are listed, traded, and settled just like shares of the US companies. Settled just like shares or securities. It's like securities of US companies. What are we saying? Each ADR that a foreign company issues represents an underlying share or number of underlying shares. So an institution over here issues depository receipts based on the number of shares right there. They are listed, traded, and settled just like securities of US companies on the NYSE or the NASDAQ. Let's move on to the second one. Global depository receipts. Global depository receipts. So for consistency, underline in red. We're saying that a depository receipts or depository receipt are depository receipt, or we say, let's just describe what it is. A bank, pardon me for that, a bank issues shares of a foreign company in international markets. Typically in Europe, and makes them available makes them available to investors within and overseas, to investors within and outside a country, outside a country, Let's stop there first and we proceed. A bank, maybe a depository bank, issues shares of a foreign company in international markets, typically in Europe, and makes them available to investors within and outside a country. So this is the country here. This bank or a firm over here makes a deposit in terms of the shares with this bank over here. This bank then issues depository receipts in foreign markets like that. So once it issues foreign depository receipts in foreign markets, investors in Kenya, in Uganda, can actually invest in those securities in those other countries once they've been issued that. So that's a simple way of how to invest in foreign securities. So we're saying that a bank issues shares of a foreign company in international markets, typically in Europe, and makes them available to investors within and outside a country. So that is it for global depository receipts, but we may proceed as a conclusion, as a parting shot, and we can say that many global deposit GDRs, are denominated in USD, US dollar, but some may also be issued. In euros, and are traded on the LSE, London Securities Exchange, or Luxembourg exchange. So many GDRs are denominated in USD, but some may also be issued in euros and are traded on the LSE, Luxembourg exchanges, amongst other exchanges there. Once we've discussed the second one, which you're saying is global depository receipts, we move over on this other side and discuss others. Foreign direct investment. Number 3, foreign direct investment. And we're seeing under the foreign direct investment right here that one is expected to open a global account with a broker in your home country, e.g. Fidelity, or to open an account with a local with a local broker in the target country. In the target country. That is it for foreign direct investment. You decide that this is Kenya, you want to invest in Uganda, you go and open, say, for example, a CDS account, Central Depository and Settlement account in Uganda. Then once you open a CDS account in Uganda, you can be able to invest or purchase securities as the way you'd actually wish. Of course, when currency flows from Kenya to Uganda like that, we expect to have that what we call exchange rate or conversion exchange rate between Kenya and the Kenya shillings and Uganda shillings there. So you need to convert the Kenya shillings into Uganda shillings for you to be able to participate and invest in securities in Uganda. That's what you're saying, direct investing. And so we're saying that one is expected to open a global account with a broker in your home country, e.g. Fidelity, or to open an account with a local broker in the target country right there. So there are two ways there. So first of all, open a global account with a broker in your home country. So in your home country, which has got if your country has got, say this is Kenya, has got a global broker over here, then that's one of the ways you can be able to participate in foreign markets, and you'll be able to trade using that broker over there. And the second case is the one that I just given you over here. You decide to open a CDS account right over here, and then of course you convert the Kenya shillings into Uganda shillings so that you can be able to participate in foreign markets there or invest in Uganda. We're saying number 4, guys, global mutual funds. Mutual funds. Global mutual funds is also another way. Pardon me, I keep underlining with black. Global mutual funds, we're saying here, one can opt for a mutual fund. One can opt for a mutual fund that focuses on international equities or fixed income. I said opt for a mutual fund that focuses on international equities, focuses on international equities or fixed income, That's it for global mutual funds. One can opt for a mutual fund that focuses on international equities or fixed income. That's it, by investing in a pool of products. So this mutual fund accepts funds all over the world. And then it is, of course, professionally managed by a portfolio manager right over here. And so now this is Kenya. You are the one who's actually invested in that mutual fund that could actually be focused, maybe say, or divided into two, maybe fixed income and maybe equities like that. So this is Kenya. Investors actually invest in fixed income part. They also have an option to invest in the equities international markets. Mutual funds that are available to international investors. Number 5, we're talking about multinational companies. Number 5, multinational companies. And here we can be able to say that occurs when domestic companies, when it occurs, saying that it occurs when domestic companies that desire significant sales, that drive significant sales, that drive significant sales right over here, from abroad. From abroad. From abroad. So let me now highlight the salient points. So when domestic companies, or it occurs when domestic companies that drive significant sales from abroad are purchased. Full stop there. For example, we are saying if we have Coca-Cola company in the US market over there, Coca-Cola, significant sales of Coca-Cola actually come, ladies and gentlemen, from foreign or from maybe the customers who are actually abroad from the US there. So Coca-Cola, e.g. Coca-Cola. So significant sales of the company, yes, it's an American company, but significant sales or significant revenues of Coca-Cola actually come from outside the country there. That's how you can be able to participate in investing in international markets, how you can be able to invest in international markets over there. You could also invest in international markets based on using, foreign, forex trading. 6, forex trading, where you buy and sell currency pairs of companies which are, or not companies, buy and sell currency pairs of countries or exchange currencies. Say, for example, Euro USD stroke CHF or Euro USD. So investing in the Euro USD currency pair using forex trading, you are also in a way investing in international markets there. So this is also another way of how you can be able to invest in international markets, amongst other ways. But these are the most common ways of how you can be able to invest in international markets. Now, to conclude, we will discuss about the factors to consider, when selecting an investment stroke asset class. The first one is security. Let's talk about when investing in asset classes, they need to provide some element of security such that it cannot actually be stolen by someone or cannot be purchased by someone unless you actually authorize for that. Number 2, liquidity. Securities must at least provide some element of liquidity at short notice. So when you want to sell off your asset class, or maybe say if it's real estate, then you can be able to do so with relative ease. That is liquidity. Number 3, asset classes should be able to generate some element of return. So an asset class or an investment should be able to generate some return. There are times when they may not be able to generate positive returns, but at least after some time, an investment or an asset class should be able to generate for you some return. There, number 3, growth. They should be able to maintain their purchasing power. So growth is also a significant element of it. And of course, growth is tied with inflation. It's tied with inflation. So securities should be able to actually grow in terms of capital gains there. So having discussed about these factors to consider when selecting an investment, we can be able to end this session, ladies and gentlemen, so that I can be able to give you an assignment for you to be able to just review. So the assignment that I have for you today here about explain the methods of investing in foreign equity securities. explain the methods of investing in foreign equity securities. That is what I want you to go and break down and understand, so that you can be able to comprehend this part of investing in international markets. Thank you for being with Manifested Publishers. God bless you.